amid all the geopolitical concerns, let's bring in Paul Hickey, co-founder of Bespoke Investment Group, and David Albrycht, five-star bond portfolio manager at NewFleet Asset Management, which has $10.7 billion under management. David, if I need to, can I hide somewhere with you in fixed income, or am I setting myself up for disappointment?
I don't think so. I think we've last year we de-risked the portfolios based on relative value. The trade in leverage finance was up in quality, so double Bs in high yield, double Bs in leverage finance. We have a lot of powder dry. We've switched over to the consumer. We've reallocated and diversified away from corporate risk to go into areas which will really be less sensitive to geopolitical risk, like asset-backed securities and jumbo mortgages, which are backed by the consumer.
Is it a year where we're going to have to worry about principal risk because of rising rates, or no?
I think with $11.2 trillion of negative rates around the world, rising rates are going to sort of be muted. The range on the 10-year Treasury, we're looking at 175 to 2.25. So unless we see a breakout on the upside with growth in the U.S., right now we're looking at trend growth around 2%, moderate inflation, a Fed that's on hold, central banks which are very accommodating.
Yeah, so you'll get return of your principal plus a little bit.
Selectively we're finding opportunities in some of the fallen angels. So, for example, in high yield, a company like Teva that has opioid exposure, generic pharmaceutical company, we played that. Some of the others.
What's that yield? What can you get there for a yield?
So yields on a double B are about 8.5.
You can find some. Yeah.
Yeah. I mean, obviously they're case by case, and I think, more than ever, issue selection is extremely important, because if you have a bond that's down 30 points, to your point, Joe, if you're getting coupon plus a little, very difficult to make that up. So it's loss avoidance.
There have been concerns about corporate debt, about the amounts of it, and about concerns about what could happen to some of those things. Do you worry about any of that?
Absolutely. You got to do your homework. Vintage deals that were done in 2016, 2017, probably over 60% have missed their targets. So you have to do your own due diligence. You have to actually look through the credits. That's why active management is so important. You don't want to buy an index, especially in the more esoteric sectors. Like last year in high yield, you would have owned energy. Mm-hmm. That was an underweight for us. You would have been overweight to triple Cs. We overweighted double Bs. So active management is more important than ever right now in fixed income.
The reason I was talking to you is because it'd be nice to be able to have part of your portfolio in something not exposed to the stock market. So, Paul, you're neutral on the markets right now, equal number of pros and cons that could sway the market. Is that what you said in January of 2019?
So in January of 2019, we were coming out of the fourth quarter, the weakest fourth quarter, in years, and the weakest December. What the history, the precedent talked about good years following in the first quarter and after. Coming into January of 2019, I think our biggest mistake was that typically markets have always retested when you've seen that type of pullback, and we didn't see that this time around. So you have to adjust. And
did you ever get long?
Throughout 2019, yeah, we were long. I mean, we
really long. I mean, you could have done 30% if you just.
Yeah, so if
you got out of your own way.
So if we were fully invested, yeah, we would have done great. We added exposure throughout the year, and once that test, and we started to see the uptrends. But to the point of what David was saying, and or getting back to what you were just saying about being neutral, equal number of pros and cons. What I want to stress there is that doesn't necessarily mean neutral. It means what's to stop us from having an average year in the market. And an average year in the market is high single digits to low double digit returns. So it's not to say that an equal number of pros and cons, it makes us look for flat equity market returns going forward. It's more of what's to stop us from having an average year. And to what David was saying, if we see the 10-year between 175 and 225 throughout 2020, I think it can be a very good year for the stock market, because the Fed is one of the best. The Fed being loose going forward throughout 2020 is great. If we do see inflation rise and interest rates start rising higher than 225, I think that's going to be a problem for the equity markets. But right now, that's not the base case. And if we do see rates steady, I think that's very good for equities.
So if you could know one thing about whether to stay long or fully investment, it would be the range of the 10-year. So all this other stuff we talk about, geopolitical and unknown unknowns, if you knew where rates were going to be, you'd stay long and get high single digits or low double?
Yeah, so I mean, I'm not an expert on the Middle East by any stretch, and I won't pretend to be. But I think over the last, I mean, in my entire life,
we have an election coming up too, and an impeachment, and we have all kinds of things.
Middle East has been a tinderbox, and especially over the last 3 years, we've seen multiple headlines over the last several years where we're being told that we're on the brink of war. It was with North Korea 2 years ago, and that didn't materialize. And if you panicked about the headlines then, you wouldn't have you would have missed out on a lot. So I think you have to put these headlines. Could something really flare up and get bad here? Possibly, but that's been the case forever, and it hasn't materialized. So I think using that as your base case isn't probably the way to go here.
Could, if there were something in the Middle East, would you think it'd be oil that would derail things, or have we make enough here now? Where you'd have to think about oil too.
We're the swing producer. I mean, right now the state of Texas produces more oil than Iraq, Venezuela, and Iran combined.
Is that true?
Yeah, 3 million barrels a day. For us, exactly. If I think oil is going to rally, I could play some sub-Sahara Africa countries like Angola. I could do Guyana, which are oil plays. The high yield market. Yeah. Energy, dramatic underperformer last year. We could look at some of the energy names, the E&P names, but again, you got to do your credit homework because a lot of those are exposed to natural gas.
These equity guys got nothing on you.
Nope.
You got more stuff you can think about. So you're stuck
14
with
sectors in the bond market.
You're stuck with fixed income, boring yields, but you have made it. You look all over the place for stuff.
Emerging markets look good.
So you're not envious of Paul.
I'm envious of David.
You're envious of him, even though he's fixed income. That's unbelievable. 2% yields. And you're finding stuff. Angola bonds, huh? What should I buy over there? Triple.
What would I be?
Is it AAA in Angola? Real AAA?
No, absolutely not.
What is it?
It's single B.
Single B.
Yeah. So obviously you got to take credit risk, but if you do it diversified, you can actually make money in fixed income. And being a multi-sector guy, I can go into any sector out there where I feel there's value.